Okay,
Got it.
everyone. Hello. We're here with Tom Basso, and this is going to be interesting, fun, and I'm sure educational. Tom, thanks for being here.
It's my pleasure, Mark.
Yeah. And so let me start off just by saying that I've had a lot of influences over the years. I'm now trading for almost 40 years, 30, which is I hate to say that, it's scary. I, I'm sure you've
I
got
got you
a
beat.
bigger number, yeah. It just shows how old I am. But I'm in the market for 37, 38 years now. And going back, we were just trying to figure out, it was 25, 28 years ago. I read this book here, which was The New Stock Market Wizards. And this is actually the original copy. I read, of course, Market Wizards, the first Market Wizards prior to that. And then I was in the next Market Wizards, which came many years later. And Tom Basso was in this book. And I went back and found my notes in there and the things that I highlighted and circled. And it's really interesting because I haven't looked at them in, I don't know, maybe 15 or 20 years. So I decided to just, without even reading them, just going in back, and we're just going to go over the highlights. And Tom and I are going to talk about that and sort of go backwards and then see where we are today and kind of figure out, what that meant to me and meant to him and what it means today. Also, if you want to learn about Tom, if you don't know about Tom, if you've been maybe living under a rock, or maybe you're one of these young guys who doesn't know who some of us are, some of us older fellas. This book here was written by Mike Covell, who is a friend of mine and a wonderful writer. And as a podcast host, he's really great. I love doing an interview with Mike. So you
that,
can read
that
about,
was that was our COVID project. We had nothing else to do, so we
yeah.
decided to work on that book.
Yeah, so Tom, you've become, a living legend, like a lot of these guys in Market Wizards, and have contributed. You have contributed to my learning over the years, and again, we go back to, I think it was 92, maybe, that this book or somewhere around there, 92 to 94 or so. So
I
let
was
me
thinking it was 94 or 5 maybe, but
94 or 5, yeah.
somewhere in there.
So I want to touch upon a few things here. I want to start off with because a lot of our paths, we go back and we look at all these stock traders that some of study and maybe try to emulate. Most of us didn't start off successful. And Tom, I see here, if we start right off, Jack Schwager was asking you, saying that you started in the financial markets with futures, and it took many years before Basso was able to trade futures profitably.
Yeah,
And
4.
4 years, right? So Tom, it took you 4 years to become profitable. It took me about five
Uh,
or six. Um,
yeah, it
so
was.
yeah, why don't you explain?
Well,
Well, here's the question I'm always asked: how did you make it through all that time and stick with it and not
yeah,
quit?
I get asked that a lot too. Um, Basically, being the engineer that I was, I got a chemical engineering degree out of school. So I approached the futures markets. I mean, I started out by simply taking a bunch of charts and getting in a chair, and I threw the charts down on the floor in front of me. So I'm way, way far away from those charts. And I said, now, if I were to look at those charts, what kind of markets would I want to, trade? And I'd say I could see that corn trade over there, and I could see that live cattle trade, and that gold trade would look good. And then I gathered them back, and I started focusing in on the 10 trades that I could see from a distance. That led me to be much more of a long-term trend follower. And what ended up happening in the first year is I had no clue what I was doing, small account, no diversification, position sizing was nil. I didn't have enough money to do position sizing. And naturally, I lost money. Then I realized, I think what I did was I had this mentality of, hey, I just paid X thousands of dollars to go get a chemical engineering degree. This loss that I'm taking in the markets is my tuition at the College of Trading. And I'm going to learn from the course that I just took this first year. And I'm going to go next year, I'm going to do better. I'm going to learn from my mistakes. So I logged in my trades. I tried to analyze them, tried to say, did I actually do what I was supposed to do? Was I actually running my strategy, or was I just something went wrong that day and I never got the trade or I didn't
Right.
follow my strategy.
Did you stick to your plan?
Just stick to it, to the plan. So I got better and better at sticking to the plan. Was making good money as a chemical engineer back in those days after the oil embargo. That was a sweet time to be a chemical engineer. So I was dumping money into my account. My account was getting bigger from infusion of capital, plus I'd have the occasional gain here and there. I expanded my diversification. I started keeping my position sizes as low as I could, basically one contract in a lot of cases. And again, learned again, lost less the second year. And that was kind of key because I'm on the right track. I'm losing less.
Right.
The trend is good. And the third year, I was almost break even. I was slightly losing. And by the fourth year, I finally had a positive number. And it was small, but as things got bigger, pretty soon I'm trading $100,000 in commodities and things got a lot easier. I could diversify the risk a little bit better. It stabilizes the returns.
$100,000 back then was a lot of money compared to now too.
I bought my first house was about 100,000. Yeah,
exactly. Let me ask you a question, Tom. So I often say, it took me a lot of years to get this, to even become profitable, let alone to get it right. But information moves a lot quicker now. You're able to see things like this. I was reading books in libraries that had strategies that didn't work in the first place, so we had to figure it out by ourselves, so there wasn't a lot of mentoring. But I still think even with the mentoring, you can't force experience. I mean, you still got to have some experience. And what I always tell people is that, I think it's important that you kind of either blow up first or have that trouble for a while, because if you come right out of the box doing great, you think this is easy. And next thing you know, risk goes out the window and then the big blow up comes. Well, exactly.
So you get slapped on the side of the head big time.
Big time, yeah. And I see that. I've seen that in more recent times where you get a lot of these younger traders, and they get into a good market, and I know the world of hurt is coming at some point, and they don't realize it yet. But you think it's important to to go through that and to gain that experience, on the downside as well.
Yeah, it's very useful and educational, and I do call it the tuition of trading, or college of trading. And it really worked for me. I had no success initially, so I had to fight my way through it. And I also didn't have enjoytheride.world website to go and read books and see interviews. And
you froze there for a second.
Oh, okay. Sorry.
That's all right. Go ahead.
I'm back.
Yep.
A lot of the the resources out there now with all the web, your stuff, you've written several books. I've written several books. We've got countless interviews of me now on our website, the enjoytheride.world website. They're all free. You can listen to them. There's got to be, I don't know, 20, 30, 40 hours worth of interviews I must have done over the years on all sorts of topics. And
sure.
So what
the learning curve is definitely much shorter now.
Yeah, and the ability. I mean, remember back when I'm trading corn, my first trade in corn, I'm calling a Heinold broker. That broker is running a ticket over to his teletype. The teletype is wiring it to the floor. The floor is giving it to a runner. A runner is taking it out to the pit, handing it to a guy in the pit. The guy in the pit executes it. He throws it on the floor. The runner picks it up, takes it back to the teletype, goes back to the office, over to my broker, and he gives me a phone call on a landline. And that whole process is, like 25 minutes maybe. Right. I'm a nobody. So at that point, so nobody is going to rush that order. And nowadays, I'm sitting here with my interactive broker stuff on another screen over here, and I go ahead and I hit the button, and I get another message over here saying it's executed already. If it takes
before you get your finger off the mouse.
I know, exactly. Yeah. I mean, it's so ridiculously different.
Yeah, I've actually, if I had some younger guys that actually call me a liar, they say, you're making this up. It couldn't have been. I tell them the same thing. I had a call. They take it down. They call me back, and that whole process and spreads. For stocks, I traded back. In the 80s, even in the early 90s, Nasdaq stocks sometimes had spreads of $3 to $6.
Yep.
and it was just, and commissions too. Remember what commissions were? I was paying, when I first started trading, I was paying about $200 a trade.
Yep.
And then when it finally came down to 60, which was oldie discount. I don't know if you remember Ernie Oldie.
Oh, yeah.
He opened oldie discount with $60. We were like, wow, this is like, deep discount brokerage.
Right.
That's when we started being able to actually trade a little bit. And it was more like, swing trading, or even a little bit longer term than that. Before that, we had to hold for these big moves because it was just so expensive. Now you
would eat you alive.
Yeah, now they go in for pennies.
And the floors used to make a lot of money off of the bid-ask spread and the commissions, I suppose, but the bid-ask spread was substantial. And nowadays they've got the bid or the pricing has gone all the way from a quarter of a point in the old days to now down to, cents or fractions of cents.
Fractions of a cent they're trading.
If you want to do it by computer. And then now the exchanges have to resort to selling their data for a subscription price or something just to try to make some money. There's no other money to be made out there anymore.
No. So it's I went down to the New York Stock Exchange. I used to go down there quite a bit. I did a lot of TV interviews down there when I lived in New York City. Art Cashin is a friend of mine, and I went down there, and I remember there was 800 or 900 people on the floor of the exchange. Then I went down there years later, and they closed the garage. Then they closed another room. There was one room left, and I went in there, and there's Art Cashin. He's sitting over on a stool in the back where he's been sitting for I don't know how many years, and a lot of years. And I came over to him. I said, Art, it looks like a ghost town. He goes, yeah, there's like 180 people left, and I don't know how long they're going to last, but it was just a ghost town. Right. So things have really changed quite a bit. But here's where I want to segue this into. But I don't believe that the markets have changed. Though people say everything has changed. It's gotten faster. There's no doubt about that. It's gotten faster.
Computers.
Information flows very fast. But do you think that really anything? I mean, from the Jesse Livermore days to the Nicholas Darvis days to our days to current time frames, I mean, do you think it's really that different this time?
Yeah, that's a really sharp question, and I would answer it this way: no, it's not really. The psychological profile of a market that you've seen the old cartoon where, some guy starts saying buy and then the next guy says buy and everybody's jumping on and speculation goes over the top and everybody's enthusiastic about the whole thing. And then it starts caving in and everybody's thinking, is this a pullback? And then, it's a little bit more than a pullback. This is starting to hurt a little bit. Right. And now I've had enough and I need to get out. And then they get depressed and we get the bottom again. And then we start the process all over again. The difference, I would say, that has changed is the speed of that same exact cycle happening. Right. We can pull off, when I graduated out of college with a Chem E degree, it was 73, 74, bear market, the end of it. I came out in 74. So I got to see the S&P get ripped by 50%. And people nowadays, unless they're going back in ancient data, don't even know that. And the point you got to realize is that in 1974, during the depth and the end of the bear market, they would break open champagne on the New York Stock Exchange if they did 10 million shares a day.
Right.
SPYs do over a couple 100 million by itself. The exchanges do over 1 billion. It's all information processing. And so the same thing occurs, but now you can pull off that 73, 74 bear market. You could probably do it in about, what was the COVID crash? At most 2 months. That was a pretty severe crash.
Yeah, things are compressed. The time frame is definitely compressed. And talking about volume, another thing that people have a hard time believing sometimes, I tell them, when I first started trading Walmart, first of all, Sam Walton was standing on a soapbox in front of the store, trying to get people to come in the store. All right. So that shows you how, a small company it was. And they would have days where the stock would trade a couple thousand shares in the entire day. Yeah. So, and now, of course, where these companies trade tens of millions of shares a day, which is more than the entire stock exchange traded.
Exactly.
So another thing here and again, everything that I'm talking about here, I'm pulling from my highlights. I mean, I have all these highlights. Look at all these highlights.
I know.
I didn't highlight these today. This was highlighted 25 years ago. So I read Tom, I read, all these guys. I read everything I could. Right behind me, I've got a couple thousand books in my library, and I've got another couple thousand. I've got about 4,000 books. So I'm a big reader. So I'm just going over this stuff, and I'm just seeing like a gold mine of all kinds of things here. So I might change gears here for a second, but you said here, after my years of experience, I now try to keep my models as flexible as I possibly can. Now, so this is something that I always, because I'm a big believer in, in really committing to a strategy and becoming an expert at something, because it's hard enough to just be good at one thing than it is to know a whole bunch of things. So what I always say is, I'm okay with if you're flexible with your observations and your tactics, but not your philosophy. So what I'm curious, because you're more of a system trader, right? Yeah. Mm-hmm. So, and that's different than what I do, but there's still, you have so many of these rules that are the same when it comes down to the basics of cutting losses and risk reward. So how do you use a mechanical system, but you're flexible?
Okay, so let's take a market. In my mind, as a chemical engineer, I liken it to a chemical plant where you're trying to control the temperature of a chemical stream going through a pipeline. So you got a heat exchanger. It's measuring the temperature coming out, and it says, I'm too cold, so let's throw some steam in there, make it a little hotter. When we get to the right temperature, the control scheme says, I've got enough, shut it off again. Isn't that like market a little bit, in that you've got a bunch of noise that goes on every day? And I'm seeing a lot of it, as I've noticed some of your comments lately, just a lot of noise with all the volatility. And that noise, in my mind, as a long-term trader, needs to be ignored. In chemical engineering terms, the temperature's fine. Don't do anything.
Right.
In your case, you maybe just say, sit on your duff. Don't do anything. Now, outside that noise range, systematically, you could say, I'll give it 1 standard deviation, 2 standard deviations, whatever you want to do. You could have moving averages. You could do Keltner bands. You could do Donchian channels. You can invent your own indicator. But once you get outside a certain point, you got to admit the market has now made at least something of a move and is no longer randomly in the noise band. So all I try to do, my whole life, I've been trying to separate noise from information. And as soon as I see that we've gone past what I would consider noise, that's when I would get into a position, buy or sell, whatever I'm doing, long or short. I go both ways. I don't really care.
Right. Are you still trading commodities, or are you trading stocks also?
I trade 20 ETFs. I trade with a sector program. I trade some momentum. That ranges from about 10 to 20 positions at a crack. I have a short-term stock index futures trading situation that I run over about a 9-day period. I trade Bitcoin futures, and that's over a short-term 9-day leash. Then I've got hedging for my long positions that I run. And I run a 25 futures portfolio strategy that is a little bit longer term.
So let me ask you, within
got about 7 strategies or something.
Okay, so within this, this noise, that you're talking about, how are you managing risk versus reward? What is your, how do you keep a balance between risk versus reward? I mean, again, I'm probably jumping ahead of here, but I want to talk a little bit about how cutting losses and managing that downside. Because one thing I've also noticed that I've learned from you a lot, from Larry Hite too, and certainly from Paul Tudor Jones, when I look back, is managing that downside. And you've been pretty, at least you started off as pretty ultra conservative.
Mm-hmm. I still am.
Yeah.
I've had conversations as recently as a couple of days ago with a trader who was doing it the typical way that a lot of new traders do. So maybe I could go through that and show where I flip it in my mind. I think it's important to start from the premise that you are an infinitesimally small speck in a very large market. So get over yourself. You're probably not affecting prices.
That's right.
So you're just participating in the game. So if you take that attitude and you say, there's noise and there's information, and I'm going to let my profits run as long as they can run. I've been in trades sometimes for years. They just don't ever hit their stop point. Keep moving my stop up. I don't ever get it. So I just keep enjoying the ride and going higher. And so you don't know where the return is, part of the return to risk. You do know that some could go a long way and be very, very profitable. Others are going to be at modest profits. They'll offset some of the modest losses, but you can limit the loss. And the logical place to limit the loss is sort of the philosophical flip-flop of why you got in the first place. I mean, if you're getting out of the noise to the upside, so here's the noise, you're getting through it on the upside and you buy here, well, then maybe the logical point to bail out is going to be down here someplace. Now, most people say, well, all right, I'll get in here and I'm going to buy 100 shares of the stock or whatever, but I can only afford a 5% loss or a 3% loss. And they stick their stop order right here.
Right.
They're sticking it right in the middle of the noise. That doesn't make any sense to me. You're just going to get taken out prematurely and you're trading in the noise. There's no logical reason for that. So the better approach is the flip-flop. Pick the logical point the markets are giving you to get in. Pick the logical point to get out. Size your position. I don't care if you're trading Amazon, you got to buy one share because it's a big price. Buy one share.
Right.
Half the brokerage firms out there are not even charging.
Right. So you're going in, you're giving it that bigger stop, but you're going to now position size smaller. So you're going to have the same risk of equity as somebody who position size larger, but has a smaller stop.
But I have a more logical stop with respect to the market. And I haven't really, I've allowed myself, think about when we get into a non-volatile market, what happens? That's the noise.
Right.
So now I'm getting in here, getting out here, position's bigger now. So I'm loaded up when the volatility is small. And then when the volatility explodes, I'm on the receiving end of that volatility, making a ton of money.
Right. Yeah, I'm going to have to admit, I would be one of the ones that would be trading into the noise. It's not always, though. What I try to do is find where that noise is and then back into the risk. So when it gets below that noise, that's an acceptable stop. And I want that to be pretty small so I can position higher. But let's just say I can't. So I will position larger and sell with that small stop. But what happens is your timing has to be impeccable now. Now you've got to buy, like you said, you're going to get stopped out so much more because it's going to be bouncing in that noise. So I'm timing it in the direction of the trade. And, I've been doing this for 38 years. So my timing, of course, is probably better than the average guy, but your timing has to be impeccable. So you're giving more room and now you're not so relying upon that timing as much as you're giving it more room, but then position sizing to offset that risk. Would that be correct?
Yeah, I'd change one word you said.
Yeah,
I'm not giving it more room. I'm trying to give it an appropriate amount of room.
Gotcha.
Not too much, not too little. In a smaller, a less volatile market, it's this much. Right. In a large volatile market, it's that much. And it's always changing, but it's appropriate for the conditions the market exists at that time.
Right. And then again, that noise could be in a range of 3%, right? I mean, it doesn't have to be, the noise doesn't have to be an unacceptable amount of risk. It could be a very tight range where the noise
could be 1%, it could be 10%. Right. I have no control over it. The market does what the market does. I'm along for the ride. I'm just a participant in the ride.
I think the only difference with me is that I am going to stay away from the big wide noise. I'm going to go into the very tight, so I'm going to back into those very tight, non-volatile situations. So I don't like noise and I don't like volatility. I do. Well, I don't like drawdown.
I agree. And one of the most brilliant things I read in one of your books recently was, and it's so true, and people don't get this, especially the newbies that want to, put 10% of their portfolio on something and then risk it, is drawdowns are so mathematically painful to your long-term success. If you, as you do, and try to do at least, is to compound frequently but do it without a whole lot of drawdown along the way, your line is going to be curved. And over a course of a year, you could be doing trades that might look like you're averaging something stupid like 10%. But by the time you compound it for a whole year over and over again with a lot of trades, that 10% turns into, 15, 20, 30. Because you have never taken a significant downswing. It's easy to get back on your curve to new highs.
Right.
People don't. I spent my life in the money management industry having to talk to the Merrill Lynches of the world, their investment companies, and talk about return to risk. And in some cases, these guys were pretty smart about what they were talking about. And in other cases, they weren't so smart. Sure. There was a lot of tendency in the industry to go for return. And risk sort of is, it's there, you can manage it and all that. But I find, and Jack Schwager's book on managed futures was very good in this regard too. He had a chapter in there that I helped him write because I told him about one of the studies that I did, and he dovetailed it with a study that he did, and he made a chapter out of it. And it basically is that if you can get your return to risk high enough, so in your case where you try to take very, very small losses, and yet you still, have some nice returns out of if the thing's running your way.
Yeah.
What ends up happening is you get a very high return to risk, and that allows you to either leverage it if you want or deleverage it and still, come up with some great returns with a lot lower drawdowns, which is a useful function, again, to reduce your drawdowns that you always talk about.
And like you said, you can have you have smaller gains and you're compounding them without drawdown. They can turn into a very big number, and that's how I do it. Now,
exactly.
You could also have giant upside, and if you have 50% drawdowns, you'll get nowhere.
Exactly.
You'll get nowhere. So I did that work very early on, and I did the math. I did the math and realized that the key was not to have drawdowns. People think that I get these big returns, like I nailed Amazon and no, that's not the case. I get consistent small to medium returns, but I very seldom lose anything big. So the market never gets its teeth into me. So I'm always compounding. My equity line is always near a high, and there's very little volatility. And so I'm compounding. Now, if you go into the hole, now you're compounding on a loss, and and losses work geometrically against you. So now you've got to dig out of that hole, and now you're doing all that work in the next bull market just to get back what you lost in the bear market.
Exactly.
So these are all things that for those of you who haven't read the new Stock Market Wizards, which where I'm pulling from here, you should, because the Market Wizards series, particularly 1 and 2, is what I read before I was in 3. Were my Bibles. I mean, these were literally these have turned out to be classic writings, and these interviews are amazing with some of the best guys in the world, and Tom's, of course, is among them. So. This is another thing that I talk about this in all my books, and mainly in my mindset book, where I started. And there's 2 reasons why I want to go to this. Again, everything really is coming back to your interview and all these highlights that I have from 20-something years ago. 2 things you said. So one here, it says, I stopped looking at losses as problems and started viewing them as opportunities to elevate myself to the next plateau. So over the next 5 years, I gradually improved and lost each less year. And you go on to say how you looked at these losses as opportunities to learn.
Right.
And that is really that's like the mantra of my whole career and everything, is that, results aren't bad. Even bad results you learn from. And it's studying those. It's studying those results. And that's where you get those important lessons. And of course, and as you said in here, and I say the same thing, if you learn something, it's not a loss, because now you're not going to make that same mistake, and you're armed with more data going forward.
Just paying the tuition of College of Trading. I would analyze a loss, and the caveat I would give traders learning how to trade along those lines is, don't just look at that loss and then say, if I did the following 10 things and filtered the heck out of this thing, I shouldn't have had that trade or whatever. You end up, sometimes you can make your system very non-robust by adding layer upon layer upon layer of restrictions to what you're doing.
Right.
I think simple things work the best, and especially if you're trading more like you do, where you're maybe in front of a screen and you're looking for a compression pattern or whatever it is that you're looking for, and then you're ready to jump on it when it has a minimal risk level. Those types of that's fairly simple. It's
yes,
very definable, but it's also simple, because if you're, as a human being, doing this and trying to track 50 different stocks or something, trying to do it, human mind can only handle so much. So yeah. I
try to eliminate the moving parts. I want to keep it at the fewest moving parts possible. So I'm always saying, can I do this with one moving part? No? Okay. Can I do it with two? If not two, then three. But I don't start at 50, and so I'm starting with just one moving part. And even when I trained traders, when I was in New York and running money, and I had guys come work for me and I would train them, I would start them and say, look, you can trade like this one little narrow box of parameters, and you've got to trade one pattern. If you can't be profitable doing that, you're not moving on to anything else. And I would really just narrow them down so they had to focus on a specific technique and show me that they could perfect something. And then we would build upon that, as opposed to being all over the place, like you said.
Schwager had a term for that he called degrees of restriction. And what he meant by that was, it was his play on statistical terms to indicate that if you're trying to go against a random set of market data and random markets even, and you have filter upon filter, don't do this unless that's that, and the phase of the moon's right, and this moving average on 200 days is positive, and a long list of this stuff, you'll never get a trade.
You'll eliminate everything.
You'll eliminate everything. You'll be 100% reliable on zero trades.
Right.
And that's not going to do you any good. So he always said the best systems, or most robust systems, are those that you can look at all the parameters that you've got, any decision tree that you've got to go through, keep the number of things you have to look at or calculate, or parameters, whether it's a 30-day or a 9-day, that's a parameter, that's a time parameter.
Yep.
Every little parameter is adding a degree of restriction. So keep them down as much as possible if you want to be robust.
So two things about that. One is that I think it's very hard to do nowadays because we're in information overload. There's as much as we just said how great it is that we have things like this, and there's so much access to training. Well, that's the downside is there's so much access to training. So now you've got 50 different people telling you 100 different things, and you don't know where to go, and you try to blend them. But taking this back more specifically, and I always try to, and again, people think I have like these magic, screens that I run this, and it spits out these stocks that, take off with no risk. What I try to tell people is that if you have, let's say you're building a screen in MarketSmith, and you've got 100 parameters. You want earnings to be up 20% and profit margins. If you miss on one of them, and 99 of them, you pass, you don't see the stock.
Exactly.
You only have to miss on one of them. So the more you put into the screen, the more likelihood that you will miss something that's actually good, because it will meet all this criteria and miss on just one. So I run my screens very, very straightforward and very basic.
You can also, though, take the same 100 and do what I would call a multivariant weighted screen. So now you have a factor. Each of those 100 items has a certain weighting, and you put them all in there and you come up with a score. So you don't eliminate anything. You eliminate it based on the final score, and still you'll be restricting your strategy to the point where you will be moving towards a group of stocks that you think have high scores. So that meets your system, but then you got to still trigger how to get in, how much are you going to buy or sell.
Right.
There's lots of a complete trading strategy is not just all about, the price is doing this, so I buy here. That's what a lot of people think it is.
Yeah.
A good trading strategy has got to deal with, what are you going to trade? How big's your portfolio? How much capital do you have? How much are you going to risk? How many how much time can you spend doing it? I mean, if you're doing all day in front of the computer, probably if you're trading,
Yeah.
if I might be out playing golf while I'm trading because I got stops in. But you have to decide all those things and personalize it to your situation, or there's no way. If somebody tries to trade exactly the way you trade, for the most part, they don't have your capital, they don't have your knowledge, they don't have a lot of things that you have going for you.
Right.
They will likely have a tendency to fail because they're not you. They got a different situation.
All kinds of emotional idiosyncrasies and gaps in skill and all kinds of things. And with what you're saying too, with a score, now you eliminate the absolute, linear cutoff where you're not
what I call sequential.
Yeah, it's not a yay or nay. So if it doesn't meet it, you don't see it. So that would be more like an IBD ranking, like a composite
exactly
ranking.
Right.
Now it's ranked from 0 to 99, and now you're going to see it, but you're going to get a ranking. And then,
Precisely.
But see, again, you're not going to be able to just say, "Oh, I'm going to buy 98s or 80 and above and make a portfolio." It won't work. It won't.
You still will have the lack of robustness. Ultimately,
you still got to do the work. You still got to do the work. So here's something that I have like stars and circles. I'm a super ultra pragmatic. Like I take a book and I start highlighting it. Then I underline the things that I like. And then I put stars next to the things that I really, really like. And then I put a circle around the star when I really, really, really like it. So I like to boil everything down. I like to get to that very simple, straightforward, get to the meat, what I call the fillet of life. So this is one of the fillets out of your interview.
Oh, it must be good.
It says, I had developed the concept of never taking a trade that would jeopardize my ability to continue trading. That literally was a life-changing statement. Okay, there's certain things that I've learned from Paul Tudor Jones, from all the traders that I've going all the way back to Jesse Livermore that I've studied, where sometimes one sentence has literally made me millions of dollars. I can look back.
Larry Hite said similar things in his chapter.
Yes, and I'm going to be speaking to Larry Hite. We're going to be doing an interview with Larry Hite. So and I love Larry, and he's an awesome guy, just as a person himself, not just a trader. So that I want to talk about that, but that's literally my entire trading philosophy, is to never ever jeopardize my trading operation. And that was Jesse Livermore too, but he didn't stick to it. And that was learning from bad example of having you can have a great rule, but if you don't stick to the rules, then it doesn't mean anything, right?
Stupid. Yeah.
So how, why don't you talk about how, what are some of your ways or your rules of being able to make sure that you never jeopardize your account? And again, the longevity, I think once you trade for a while, I think you start to appreciate when a guy like you or me have been trading for 40 or 50 years and still in the game and have that longevity. I think you start to really appreciate, wow, this guy really must, have a really good, concept of this and approach, because it's so hard to stand the test of time in this business.
Well, and I think you've done it in your own way by taking very small risks with the positions you put on, but that you get them going the right way. You can then nail it, have a nice return to risk that way. My approach is a bit different. I'm trading 7 different strategies.
Right.
But what does that do for me? I've got strategies like if I do my option spreading strategy, for instance, to explain that, I'm looking for overbought or oversold on the short-term conditions, and then I'm laying on a bull spread or a bear spread on a market index. So I'm assuming
my head hurts just listen.
I know exactly, but to me it's I know but to me it's really simple. And it's a quick decision. I hit a couple buttons and it goes off.
Right.
And then over the next 8 days or 7 days or whatever, typically the market doesn't go crazy. It stays in some kind of a range, which it does frequently. I figure 2/3 of the time the stock market is in a sideways action, and only 1/3 of the time is either going up or down, and it's going up a lot more than it goes down.
Right.
So, but that's the time. It was studies that I've done. It's somewhere in the neighborhood of 2/3 of the time, at least 60%, you're going sideways. So this is a strategy that makes money during sideways markets. and that's fine. So I've got that going.
We could
but
have
then
used
right
that.
next to it.
I'm sorry. Go ahead. I'm sorry.
Go ahead. The next strategy, let's say you got a short-term stock index trend following strategy. That's going to make money when the markets trend. The option strategy is not going to do well during trending markets. It's going to do well the 2/3 of the time that the market goes sideways. So the option strategy is going to have a higher reliability, but it's going to lose when it loses when the market trends. But when the market's trending, this other strategy is slaying it. So what I try to do is balance all these strategies. I call it filling the hole. I actually got that term. I have to give credit where credit's due to Lawrence Bensdorp, who's runs the Trading Mastery School now. He's down in Brazil, and a good friend of mine now. And he calls the filling the hole because a track record. If you look at a track record, it's got kind of the squiggly line going up the page, and he tries to examine where are those potholes in the road up the hill. And what he's trying to do when he adds another strategy is he's trying to look at what were the conditions during that period of time and why were my existing strategies not able to handle that particular period, and what kind of strategy would typically create a profit during that type of period. And then how can I keep that particular strategy that makes money then from losing during the rest of the period? And when you get them symbiotically existing, you get closer to the flat curve that you have, the flatter curve, so you don't have those big drawdowns. And so that's kind of the way I deal with it, is I try to diversify myself. I'm trading 50 different positions right now across 7 strategies.
So I'm seeing your engineer coming out here.
Yeah. Once an engineer, always an engineer. I don't care what label you put on yourself, like money manager, currency trader, running of a website or whatever. It's always engineering to an engineer.
Yep. Well, I'm a much more simple guy. So, and I think, this is really a good example also to show how you tend to gravitate towards the trading approach that fits with your personality. Some people,
absolutely.
Some people they can't hold,
you could tell me every nuance of what you do. There's no way I can guarantee you, having read a book or two of yours, that I would be comfortable trying to do what you do every day. And likewise, if I turned over all my programs and had you sit on my desk, it would drive you nuts.
Yeah.
You would go crazy nuts looking at my screens and seeing all this stuff, and then just realizing that you're not supposed to do anything but sit here and watch it.
Yeah.
And it would drive you nuts.
And the worst thing that we could ever do is to try to do both of those. For me to try, it's hard enough. We spend our whole life just trying to do what we do and we know well. But imagine, a lot of people, when one thing's not working, they say, well, I'm going to go try Tom Basso's strategy. I'll do the options here. It's a sideways market, and now it's an up market. I'm going to do what Mark Mינארווני does, and then I'm going to do what this guy does. Then forget it. You have no chance of success.
There would probably be counseling involved.
Exactly. That's exactly right. There would be counseling involved. There's counseling involved sometimes with just one strategy. So here's another thing and this is another, huge, enormous concept that I have literally built everything around. And that is, you say here, I would tell traders to think of each trade as one of the next 1,000 trades he's going to make.
Yeah, that's a good one.
That is so key. That's so key. It is, again, how I usually tell people is I say, look, aces is the best hand in poker, right? So if you could lose with aces, I've lost with aces 3 or 4 times in a row in a poker game. But does that mean that you stop playing aces? This is a game of probabilities, right? So we're over a distribution curve. Aces are going to win, say 80% of the time. But it doesn't mean that they can't lose. So again, what you've got to think when you're in probabilities, you have to think over the long term. What is this going? If I do this for 100 times, am I going to come out? Is it a winner or a loser? A pair of twos against aces is a loser over time, but it might beat it a couple of times. You might hold your twos and flop a 2, and I have my aces, and my aces don't improve, and you beat me. But if we do that 100 times, if we do it 1,000 times, and as you know, with probabilities, the more we do it, the more the natural probability is going to distribute.
Correct. Therefore, the card counters in blackjack in Vegas that teamed up with syndicates so that why'd they do it? Why do you send in 20 bodies to count cards? Because they need numbers. Over the course of numbers, they're edging it in their favor. In my case, the 1,000 trades over my lifetime, I have not kept track of it accurately, but I think it's about 32% of the time I'm profitable, and about 67% of the time I've been unprofitable. My losers have been limited. My gainers and some of the strategies I ran, Max Trend back in Trendstead days was averaging 7-1 gainer to loser. Now, I didn't do very many trades, but if I could do 1,000 trades, I've got a reliability that's maybe down in the 28% in that particular strategy, and yet it's a 7-1 gainer to loser. Well, if you do that math, you're way, way ahead. Just go ahead and give me 1,000 trades of those.
Way ahead.
And so what you got to do is just sit there and say, and if people ask me this question, how do you, man, you're in on Japanese yen and you just made it just went from 75 to 150 and you're on leverage and man, you made thousands of % return on this one trade. Why, how can you stay in there? And I say, it's just one of my next 1,000 trades. That's the way I think of it.
Right.
It's got to be there to do what it's going to do. The very next trade I do in Japanese yen could be the second trade in my 1,000, and it could be a loser. And I don't know which one's going to be which until it's all over. So it's just,
and that's that's really important with the losses too, because people get so bent out of shape and so freaked out when they take some losses and the market's not working well and they get a dormant period where things aren't working. This is just you're going to be making lots and lots and lots of trades. I mean, I've made hundreds of thousands, if not over 1 million trades. I mean, it's definitely in the many hundreds of thousands of trades. So even if you have a short career, you're going to make a lot of trades. It's going to be hundreds. It's going to be thousands of trades, and it's going to all distribute. But here's everybody, listen up very carefully here. Let's back up what you just said, Tom. You just said that you've built a career on being right 32% of the time. Mm-hmm. That is like a monumental statement, okay? Because that tells you not only do you not have to be right all the time, you can be wrong twice as much as you're right. But you're getting your edge from managing the risk-reward relationship as opposed to having a high batting average. Now, I've argued, and this is certainly debatable, but I've done the work for decades now, and I've studied it from every angle that I found that, and you tell me what you think about this. Okay. I found, and what we've studied and found out is that when you have a high batting average, if that's your edge, if that edge goes away, so let's say you rely on 80%, and you could even have a gain that's as big as your loss, but you lose your edge. Okay, let's say you lose half your edge. So that would mean you go from 80 to 40. You will blow up a lot faster than someone who's right 30% of the time, but like you, they've got a 7-1 reward to risk or a 5-1. So if you lose half your edge, let's just say, you lose, it's instead of 7-1, it's 3-1. Well, you're still breaking even. Mm-hmm. You're still breaking even. So, exactly. And the reason, my argument for that, or what I've termed, and you might have read this, I can't remember if I talk about it in both books, certainly in my first book. It's what I call building in failure. You've already built in, you could practically throw darts and maybe be right 2 out of 10 times. So you've already built in all the failure.
I did a study where I flipped a coin every afternoon using a whole series of portfolio futures markets over a 20-year period. And I trailed like a 1 ATR stop or something. So I had some kind of a fabricated trailing stop. The computers would go ahead, and if you don't have a position in corn, then it flips a coin. And if it's heads, you buy on the opening. And if it's a tails, you sell on the opening. I ran that, and then I did Monte Carlo simulations of those runs over 1,000 at a crack. And every time I did 1,000 case Monte Carlo simulation of that, it would show a slight propensity to produce a profit. I would never trade it because it doesn't make any sense at all. but it does speak a lot to the fact that it's a statistical game. And if you cut your losses short using that trailing stop, that makes sense. And then at the same time, you get on a run that goes and you enjoy that ride, then you're going to come out ahead in the end.
That's right.
And you're flipping coins to do it. And how much time is spent in the world with traders trying to figure out how they're going to buy and sell? And I'm doing a study that says flip a coin and you can make money.
That's right. If you manage the risk versus the reward.
Manage the risk and reward.
And it doesn't really matter. The being right or wrong, you can only be right a few times, but you're making more when you're right than when you're wrong. So
when you are right, you make it pays for a lot of those losses.
And that is my whole entire strategy is managing the risk reward relationship and building in as much failure as I can. I tell people, look, I would rather have a strategy that I'm profitable at 20% versus at 80%. Because again, now I'm like, how bad could it get? 10%? I mean, one out of, so, and again, the problem with that is that people have a hard time taking all those small losses. So, and that was my next question that I was going to segue to is, okay. So when someone, I know the answer for myself, but I want to hear it from you. For someone like yourself, now you're okay. So you're right 30% of the time, 32% of the time. How do you keep the confidence going through those losses? And then, sometimes there's a losing streak and you're going to have these losing streaks. How does a trader, this is what I'm asked all the time, how do I handle having all those losses and having the confidence to stick with it?
I have a very good memory for all the things that have happened in the market in my lifetime. And whenever I'm in a drawdown and I'm thinking, gosh, I'm getting beat up here, I think of that last time I made equity highs and what it felt like and how successful it was. And then when I'm at equity highs, believe it or not, I do the same thing the opposite way. I remember what it felt like when I was in that drawdown. And what you're trying to do essentially is to balance yourself out a little bit so that I'm neither high or low. I'm just doing the next trade of the next 1,000 trades. I try to make it as boring as I can. I try to think of trading about as exciting as breathing. I don't think about when I breathe in or out. It just happens. And that's kind of what I do every day with trading. It just happens. Yeah. I don't get excited about it.
So you trust it. Well, hence the name Mr. Serenity, which Jack Swagger called, and I can see why he called you that. So this is the first time that Tom and I have ever, done this. So
exactly. I'm having fun.
And it's totally off the cuff. We haven't prepared anything whatsoever. And I literally started preparing about 2 hours before we started this. I like it that way anyway. It makes it nice and raw and and authentic. So let me see here. So here's another thing, because I'll tell you, it's no wonder why you've been a successful trader and a successful person. I've heard a lot about you just from your life, that you're in life, that you have a great life and that you a great outlook on life, and there's been many people I've heard that said that you're even more successful as a human being. So, which is, I think even a compliment. It's even a bigger compliment. But I can see why, because, as all the things that you're saying here, my mindset book where I studied champion athletes, Olympic gold medalists. I mean, so much work I did on that mindset book. And you're just talking like, everything you're saying is what winners say, putting yourself in that frame of mind of remembering, how it felt when the trade was going well. So something I want to touch on here is mental rehearsal. This is something that I do every single day. I wake up in the morning, I go through, I just lay in my bed and I go through a period of time where usually I click on the TV real quick and I just see if the market's like down 1,000 points and, when we're crashing, I know I got to prepare for disaster. And I just see what's going on. Then I shut it off and I'm in complete silence and I just prepare for the day. And I know my positions and I just start thinking about them. And, I know some are extended, some I might have, closed near the low the day before and very close to my stop. How am I going to handle if that stock that was down, let's say 5% and I have an 8% stop, it's very close to it and it closed right on the low. And I'm like, if that gaps down this morning, What am I going to do? So I prepare for basically my positions, and I just go through that in it's sort of just like a standard operating procedure now. And when nice weather, I go down to the beach sometimes, and I'll go down and I'll meditate on the beach in the morning, and I'll go through this process sometimes even there. So I do that every single day. And again, I'm going back reading. I'm going, maybe this is where I got some of this stuff, because there's so many things here that are consistent with what I do. So you talk about mental rehearsal. How is your mental rehearsal?
Actually, Tharp, who's the psych guy in the investment business, Dr. Tharp, he actually I was helping him out as a model trader way back ages ago in the 80s, I think it was. And maybe not early 90s, but he used the term mental rehearsal before I ever knew of the term. But I think it's a great way to describe anticipating taking action on something so that when it comes time to do it, you literally aren't even thinking about it. So there's lots of examples in life you could create. One of them, if there's nobody around, I don't suggest doing this in the middle of downtown Manhattan traffic or anything,
right?
Or most places if there's a lot of traffic. But come up to a stoplight, and at that point, and I'm not saying peel your tires, but think to yourself, green, go, green, go. Keep looking at the green part of the street light, and your foot's on the brakes, let's say, and you're rehearsing, okay, that's going to go green. My feet are going to be over on the gas. And there's nobody around, so hopefully it's safe. I'm not asking you to do anything that wouldn't be safe. Right. But you will amaze yourself of how fast you are actually, the car is moving after that green light goes off, because you've mentally rehearsed over and over again executing. So when it came time to do it, there was no thought. You were reacting. A lot of other things.
Preparation.
Shooting.
This is all about preparation.
Right. I was an expert marksman in ROTC back in the Vietnam years. I didn't end up in ROTC. I ended up as a chemical engineer, but that long story we don't need to go into. But I ended up with an expert marksman thing. And one of the things you learn with expert marksmanship is mentally rehearsing. When you instinctively see the sight over the target, you go ahead and you just release your finger onto the trigger and it goes.
Right.
There's no thought. You aren't actually thinking, I've got to wait till it's just right and then I've got to pull. You mentally rehearse that. And the guys that are, get 999s out of 1,000 or whatever the scores, they're doing it completely on mental rehearsal and being instinctual about having that target in the sight. And so things, for an example, in trading, that would be an obvious thing. You just described one. You might have a gap down. What do you do? Mentally rehearse a lot of things. In my world, it would be, what happens if the electricity goes down, or what happens if I don't have internet tonight? Right. What do I do?
Contingency planning.
Contingency planning, very important. What happens if you have a child who's at school and the nurse calls and says your son just threw up all over the place and you got to come pick him up? And you're in the middle of the trading day and your wife is busy. So you're the only game in town. All right, how do you handle that? Do you shut down your positions? Do you just put stops in? Do you, how do you handle it? Mentally rehearse the stuff ahead of time, and you can be Mr. Serenity, because nothing that happens really gets that stressful.
Right.
Because you've already figured out what you're supposed to do about it.
Yeah. Do you see everybody why someone like Tom Basso is successful? Do you see why? Do you see the similarity between him and I, where we are prepared? We're prepared. We are thinking through all the scenarios, contingency planning, and being ready with not only our tactics and and building our skill, but mentally being prepared to be able to execute. Just like in shooting, you could be the best marksman in the world, you could be the best fighter in the world, but then you get in the ring and you get into a real situation and you crap your pants, right? And you freeze. So you've got to be prepared and be mentally prepared. Now, Tom, I don't know if you know, but do you know I'm a competitive shooter?
No.
I didn't even know if you knew
know that.
Yeah, so I shoot lately. I this last year I haven't been shooting a lot, but I used to shoot a real lot. I have my own shooting range, which
Oh,
is a
wow.
full
No.
blown 30-acre range. Yeah, and I shoot a lot of pistols. I shoot USPSA Steel Challenge.
Yep.
So I'm and it's funny that you said that because that's really where a lot of these techniques I use and they come from. I don't know. Did you ever hear of Lanny Basham? Lanny Basham wrote a book
I don't think so.
with winning in mind. He's an Olympic
Oh,
marksman,
yes, I have. I have read the book. Yep.
multi-gold medalist, and
I did read that book.
a lot of my concepts came from Lanny. He's
Yeah.
just he's one of the best there is with developing a champion mindset. Just amazing.
Yeah.
But
That was a good book.
you're sounding. I mean, again, there's no question in my mind why you've been successful because you just keep resonating with all these philosophies and all these things that are what you hear come from the mouths of winners.
It's sort of, if you think of it this way, it's sort of making trading a business rather than just thinking of it as trading. I think trading to a lot of people, especially newbies coming in, are thinking, I look at the price action and I think it's going to go buy and sell, and it is akin to pulling the handle on the slot machine to them.
Right.
There's no idea what's going on. But if you start analyzing it as a business and you realize you have costs and you have profits and you have to try to get net income and you got to have working capital and you got to have the staff to do whatever it is that you're doing, which is probably you are the staff. But in my case, I leverage it using computers and automation to maybe trade 7 strategies where you might trade more like 1 or 2 or 3. You have a limitation being a human being. I have a limitation to some extent, but I could always add extra computers if I ran out of capacity or use servers in the cloud or something. But the point I make is that if you approach it like a business and you really want the business to be around for the next 50 years, you come to certain conclusions of things that you have to do to achieve that. And I think a lot of traders don't think of it that way. And so therefore it's the slot machine, get the big payoff. I'm going to buy the fancy car and the expensive house and live on the beach or whatever. Yep. And be like Mark Mינארווני or me up in the mountains here of Arizona, enjoying the beautiful day we had today.
Awesome.
I think you have to, I've spent a whole lifetime getting to where I am. This is not where I was when I was 25 years old and, trying to scratch together $100,000 futures account any way I could. So you have to realize that you are who you are, and this is a business. It's going to be a long-term business.
Yeah, and Tom, I try to tell people that this is the law. The dynamics of trading are no different than a business. Walmart buys get items and they turn them over very fast and they have a very small margin. That's akin to the trader, the short-term trader. A Ferrari dealership, does way less sales but has much bigger profit margins, and that's more of the investor. So so you can be just as profitable as me and vice versa, and we can get there. I can get there through a lot of turnover. You can get through less turnover with larger profits. But it's the exact same thing as any other business, and it's also, you go back to something like, what O'Neill talked about, where, you buy a bunch of red dresses and blue dresses and yellow dresses. The blue and the red are selling like crazy. The yellow aren't selling. What does a business do? They mark the yellow down. They get rid of them, right?
Exactly.
And they buy more of the blue and the red. So
cut your losses short, let your gains run.
But that's, people don't think of it that way. They don't realize that that's the exact same dynamics as you have with a business.
You got 50 restaurants, 3 of them are not even producing a profit. Shut them down.
You start shutting down your losing operations. You put more money into your ones that are working, winning, and you open new ones.
Exactly.
That's the same thing as opening new positions.
Exactly.
For feeding your winning positions and cutting off your losing positions. No different.
Correct. No different at all. Same thing.
So on going back to this, this whole mental rehearsal, I just want to, because again, this is I have all stars around it, and I can see how some of these things have really influenced me early on. Remember, I'm reading this book here when I'm 20 something years old. All right. So, I hadn't been trading a whole lot of time. I'm, I don't know, maybe 25 years old, been trading for 6 or 7 years, and I only been starting being profitable a year or so. So this is really in the very, all these things that I'm highlighting now, 25, 30 years later, I see, I have these cemented in stone philosophies that I've been using my whole life. I go back here, I see my mental rehearsal for a catastrophic event is to picture a doctor in a triage situation. And you go through this whole explanation. It's awesome. He's in a battlefield emergency operating room. Here comes in 50 bodies. Some are going to live. Some are going to die. The doctor has been trained to handle this situation. He's going to make all the necessary decisions. The patient goes into the operating room number one. This one gets pushed aside. He's calm and collected, not nervous. So these are the things I read, and I was like, yeah, I got to get where I'm like this, man. No matter what they throw at me, I'm prepared. I know exactly what to do under every situation, and that's how I started contingency planning. And I worked on my contingency plans right to the point where, to this day, I keep mirrored accounts. If something goes wrong with one of my accounts, I mean, I've had brokerage firms, I've got stories that you can't even believe on how brokerage firms just shut down. And in the olden days, they just didn't pick up the phone. I don't know if you remember that. The markets got fast, they just didn't pick up the phone. And then they wonder why people walked into the office and shot them. And that really happened. That really happened. So now you get where you can have, your internet goes down. Like you said, what do? I keep a mirrored account where whatever money I have in one account, I always have at least one other account. So if that goes down, I can short against my positions and hedge them out if I had to. So I have contingency plans for everything. I know where every Starbucks is, where there's internet. I have
Safeway up here in the mountains has their own internet. We had internet go down. They have a Wi-Fi in their cafe there.
Right. Yeah, I'm sure exactly. Where there's a Wi-Fi nearby. So just really awesome stuff here. I know we're having a lot of just conversation, but in between that, listen carefully because there's a lot of golden nuggets here.
Well, can you, for instance, let's say you lose the internet, could you have a trading platform on your phone that would allow you to use a Verizon network or something that wouldn't be affected by the internet, perhaps? Right. So it gives you access to your account, so you could flatten out your positions temporarily, or weather the storm.
Redundancy.
Yeah, exactly. So redundancies. How about if you have a computer and you trade like me? Well, what happens if your monitor goes out? What happens if your computer goes down? Do you have a backup computer? Yeah. Do you have access to the cloud to what you're doing another way? I've got a monitor in a box sitting right over here. So if my monitor goes down, I just pick that one up, I plug it in, I've got another monitor.
Right. That's right. Prepared, no surprises. And let me ask you a question. If you got a surprise, if you weren't prepared for something, then that would go into the playbook next, right?
Yeah, it would.
You're gonna now make a contingency for that.
Yeah, my rule of thumb generally is if something completely unexpected comes up, I try my best to just take it and eliminate whatever I'm doing until I can figure out what the plan is with this included now. So I sort of take a pause, keep myself protected, make sure that nothing's strange going on, and then work on that problem, solve it, and then bring it all back up again, and we're back to normal.
Notice another thing, everybody. If you listen to what we've been talking about through this whole entire time, you see how we're almost always talking about the risk and taking care of the risk, and we very rarely have ever said anything about the upside. It's all been just making sure that we're keeping ourselves what I call buoyant and safe and not having big drawdowns, and the rest takes care of itself. And this next comment that you have here literally was the pivotal point, and whether it came from you or whatever it came from my own epiphany, it certainly was the turning point in my career. A lot of people say, how did you go from losing for 5 years to being in Market Wizards and winning U.S. Investing Championship, making millions of dollars? Well, this is when it happened. This was the change that I made. And you say it perfectly here. You say, I focus my attention on trading well and let the results take care of themselves. And my change came when I said, you know what? I got to stop stressing about the money here. I've got to come up with rules that make it where I don't have to stress about the money, and then just follow the process. And So what I did was I took anything off of my screen. You know, you have the little ticker and it shows like your P&L, and it's ticking up and down. I used to have it where it showed my entire P&L, the net, and then I have each of my positions. So now everything starts going against me and it's like, negative, and you just see money draining out of your account. So the first thing I did was take that off the screen and just say, okay, I have my stop loss already. I've already decided how much I'm going to lose. There's no sense in looking at it and stressing over it because that's the number. If I start looking at it, I might circumvent that plan. So that forced me to have my plan up front. And so I got out of the what I call calling audibles, where I'm making decisions, as it's happening, and said, no, I'm going to make my decision ahead of time. And then I stick with it. And then once I make the decision, I'm out of the trade. I can go back and say, okay, was that a good plan, a bad plan? And now make adjustments. And that really was the pivotal change where everything changed for me when I said, forget about the money. I'm just focusing on being the best trader I can be. And you're saying exactly that.
The same thing. I like to actually, I say that statement just even slightly different. And it applies to everything in life, is concentrate on the process, let the results take care of themselves.
Right.
You can do that in cooking, you can do it in winemaking, you can do it in golf, shooting, whatever you want. I mean, concentrate on the process, let the results take care of themselves. Get rid of the score. If you can concentrate on your golf game and hitting a good shot, your score will be fine. Don't worry about your score. Concentrate on the process. And the other thing that you said was interesting, when you dropped out all those negatives, the same thing can happen, I see, to people who have that item there and they're all green. And everything's green. And you're starting to look down at the total and going, holy crap, I can buy a new fill in the blank off of that much money. Maybe I should take some profits. And then all of a sudden you abandon your strategy early and you don't let that run go. You don't let that big winner.
And then you wonder why your profits, your risk reward ratio is out of whack.
It's lousy.
Because now you're overriding it. You're letting that emotion. Right, exactly. This is what I talk about, the emotional idiosyncrasies that you come into your trading.
So I'll credit Tharp with this one. He has a statement. He asked a lot of traders, what's a good day for you in trading? And they'll usually say, well, if I'm up like $1,000, or if I'm up $500, if I have 1%. And he says, no, a good day in trading is a day where you followed your strategy to the T. You didn't make a single trading mistake. It has nothing to do with whether you made money or not. You just did another day of doing your plan. And that's so true. It has nothing to do with whether you're up or down.
You said it, process. And that's process. That is what I try to do with everything in my life, and I've been doing it for many, many years. And just, if I get the process right, the result is going to be good. If I have a good process, of course, you have to work on developing that process. So I work on, and you said shooting, and that's what changed my shooting too, because I went from a subpar shooter to a pretty good shooter that was going from never winning to winning lots of competitions. And I used to always stress about the outcome. I was like, I'd go in there, I'd go, okay, I have to finish at least in the top 5. If I don't finish top 5, I'm going to be upset. And then, that would, when I start, I blow a stage and I'm like, oh, I'm never going to even finish, top 5 now. And oh my God, I'm going to be top 8. And I'm just stressing over where I'm going to place. And all that energy is taken away from, I'm supposed to be focusing on getting A's in the A zone on each shot by shot. And if I get the A's in the A zone shot by shot and I shoot a good stage, I get a good score.
Exactly.
And so I had to shift, and I said, I got to get, and it's so hard for some people, and it was for me for a long time, but you've got to change your focus and just fall into process and get off of results.
In math terms, you're concentrating on the independent variables, and the dependent variable flows out of it.
Right.
You can only control the independent variables.
I'm going to use that going forward to sound more intelligent.
Oh, okay.
Because that's a very sophisticated way of putting it.
I had to unfortunately take differential equations in college to pass my chemical engineering degree.
Here's something else too that I've noticed that there's I can see a correlation in how this is sort of how I approach a certain way I analyze. I'm really big on doing post analysis, but here's what I found, and I want to again quote you. if you're watching yourself doing everything, you get pretty close to watching a movie. The observer is watching you play a role in this movie called life. And you talk about how instead of you say instead of saying I'm going to do this trade, you say I'm going to watch myself do this trade.
Yes.
Now, so I love this, being the observer and being objective and being able to look at what you're doing as almost as an independent auditor, if you will. And what I found, and I'm curious what you think about this, I used to look at my trades like right after I did them. And then I try to do all this analysis. But what I found works better is if I sort of just put them aside and I wait a little while and I go and I analyze them. You analyze your trades like 6 months later. It's almost like analyzing somebody else's trades because you're completely removed from them. I can do it now. I can look at a trade instantaneously, and I'm so versed at this that I can look at it and I can grade it and I know exactly what I need to see. But early on, I had to remove myself and get away from the emotions and any kind of bias that I might have. So I would wait and look at them 6 months later, a year later, and then mark them up and say, okay, here's what I bought and I sold, and say, was that a good trade? Or was that a bad trade? What was my plan? But again, it made me be able to be more of an observer because now I'm looking at a trade. I can't even remember that I did it. But you're talking about being the observer. Do you notice, as far as, how do you do that? How do you become that observer and get yourself to pull out?
I'll tell the story on how I did it. It's going to be different for every person probably, but in high school, I had to get up in front of give a book report to 20 people in my English class in senior year of high school. And most of these kids in the class I had grown up with. I mean, they've been in my class since kindergarten. It was a small town. And my hands are shaking. And so that night I went home, and this is the first time I did that post-analysis you talk about. And I said, Tom, you were ridiculous. Basically logically looking at what I did and thinking through, I mean, John was over there. I've known him since before kindergarten. Alfred lives down the street from me. I've known him all my life. Why am I nervous doing a stupid book report, which I did read, and I wrote the book report up. I mean, probably got an A in English, I'm guessing. So I finally started doing that a little bit more. I had situations like I was a nerd all the way in high school. I'm going to my high school reunion, by the way, in a bit. So it'll be interesting to see some of the old guys. But, what you end up doing is analyzing, like you said, after the fact, your trades. And you see the fact that, gosh, I didn't even follow my strategy with that one. What's up with that? That's stupid. Right. And you start realizing that you got to get closer to real time. So to me, there's a function called awareness. And what I would recommend people do, if traders want to really do some experimentation, I can do this with the Zoom. We'll do this live, and then traders can do this at home in their mirror if they want, or they can fire up a Zoom screen and look at themselves. But if I'm looking at myself right now, and I want to be pissed off at what you're saying, then one part of me's got to be able to look at the screen and feel the muscles in my face. And the other part's got to physically, what did Mark say? What is he, stupid? Right. So I'm one part is controlling, one part is observing. And you can do that in front of a mirror. If you've ever given like a speech, a book report, I should have done this. I didn't do it. But I'm totally comfortable. If I'm sitting at lunch in some 500 person audience and somebody said, Tom, would you get up and say a few words about X? I'd say, sure. I wouldn't. I'm right now speaking to you. I don't know how many people are going to be listening to this down the road. Sure. I'm having a blast doing it. And so I think what you have to do is, in trading, I have to be aware of myself enough, be kind of watching myself all the time. And if I'm about to get greedy and take a profit on a big position and not let my profits run, and that observer self feeds back to the guy who's doing everything. Hey, you're not really following your strategy. And then your disciplined self can say, yeah, you're right. I should just do this and go on and play golf or do something else. Get out of here. Go walk the beach in your case.
Another thing that you're bringing up here, and I think it's again where this shows on how, just like any other business, when you're in business, when you work for somebody, you have a boss. They tell you what to do, or you have projects that you do. When you work for yourself, you've got to be the boss and you've got to be the employee.
There you go.
And trading is working for yourself.
Uh-huh.
So you have to be the boss and you have to be the employee. Now, you said something, and again, this is, I have like all kinds of bells go off when I hear these, these key things. And some people may not hear these little, maybe that sound insignificant, but they're very significant in how you approach this. And when you said, Tom, you looked back and you said, Tom, you were terrible. You were, basically, and I don't know if you read, I always tweet, I've tweeted it a million times. It's my 10 tips for going from mediocre to super performer. And number one is admit that you suck. And people are like, what? Why would I say I suck? Well, you probably do suck at most things, because otherwise you'd be really great at them, and you'd be really rich, and you'd be like a gold medalist, and you'd be winning competitions and awards. Yeah. So we suck at a lot of things, but with trading, or when you're trying to be great at something, you have to be objective, and you've got to be honest, and I did with myself what they do in the Army. They break you down and then they rebuild you in their image. But first they got to basically destroy your self-image of yourself, and so, but here's the key. The key is, it's not about being negative and saying you suck, you can't do this. It's you suck, but you can be great. You only suck because you lack the knowledge and the expertise and the experience. And if I practice, I can be great. So rule number 2 is, know that you can be great. Rule number 3 is to find somebody great. And rule number 4 is to shut up and listen. Those are the first 4. And so that was a big change that I made, that I had to say, you know what? You've been doing this for 5 years. You're not profitable. You really suck at this. Now, what do you want to do? Do you want to quit? Or do you want to get it right and start doing this right and listen to someone who knows what they're doing and start playing by the rules?
I ended up in basketball, playing a lot of basketball in college, and I started observing guys behind me. That if you disappear out of the right side of my vision and they don't come out the left side of my vision, they're still back there.
Right.
Your brain's got to keep track of that stuff when you're playing basketball, because you don't have the time to turn around and go, is he back there? Because then something's happening in front of you then. So you end up sort of having this control of your brain where it starts out, in my case, as almost having these 2 brains. One is watching Tom do everything, and the other one's Tom doing the thing. And that's kind of merged into just an awareness level. But awareness is very important. You can get lots of books on increasing your awareness. And I would heartily recommend traders do that, because once you're aware of how the market is pushing your button, making you greedy, making you fearful, making you anxious, making you fill in the blank, there's a million of them.
Yeah.
Then your observer self, or your awareness, can kick in and say, all right, I'm aware of Tom's now starting to react a little bit anxiously towards this. What does Tom need to do to not be so anxious anymore? Get back to nice, even-keeled Mr. Serenity. And without that awareness, I don't know how you ever correct back. For me, when I was in my 20s, I was downing a pot or 2 of coffee. And I was so caffeinated. I was just full speed ahead. We were trying to raise money as a young money manager. I felt like I was working 5 jobs at the same time. And, I was very successful. I had poured my energy into it. But at the same time, I started realizing as I got into my 30s, might be better not to have coffee, maybe switch to decaf. And just make myself enthusiastic based on the excitement of the day, and don't infuse chemicals into my body to jack me up even more.
Sure.
And the more I went decaf, the more awareness came in. the more I was more even keeled, the more I could see alternatives to, instead of just doing this impulsively, maybe I could do that instead, or maybe plan C. And I think that as a trader is a very useful thing. I think the market's already pushing your buttons enough, and it's asking you to act very quickly. So there isn't a lot of time. And if you mentally rehearsed what you're supposed to do, fine. But if you've got time to sit there and watch those greens and reds, all of a sudden amazing things happen that you don't want to happen.
You're not kidding. I call it building in stress protectors, like, because people say, how did you last all this time? And, when you trade, I talk about how, sometimes I trade these giant positions and they think that it's so nerve wracking and it's so, oh my God, you must be stressed. Not at all. I have no stress at all from trading. I mean, I'd take a $10 million position and put my whole account 5 times leverage, and I'm not stressed because I have a plan and I know exactly what I'm going to lose. I know where I'm getting out. I have all my contingencies. So I'm like you said, I'm prepared. I'm mentally rehearsed. But it took me years to build these sort of I guess this framework.
Stress diffuser.
Yeah, this framework that I operate within. People stress me. Things stress me that I get more stressed if my juice machine doesn't work than over a trade. I can't have my green juice in the morning. So I want to just say a couple things, and then we're going to wrap it up with one last thing from the book. First of all, again, I can see how you'd be the kind of guy like as a young man I'd like to have as an uncle or a dad. So because you're really just even keel and just very logical, and it's really it's what I want to say here is that I know people watching this are you probably wanted to see the charts and the systems and the buy points, but guess what? This is the important stuff. This is the important stuff, right? Because this is what gets applied to any system. You're going to need this regardless of what system you use. And this is the stuff that makes you into a champion, not the system. So, so this is the really good stuff. I want to end with one last thing here. And this is sort of, it's a little bit different, but I had to flip things around. I started off with basically exactly the opposite of what I ended up doing. I started off buying stocks at 52-week lows that were low price, that were beaten up, that were pieces of crap, and bargain hunting, and I changed that. But what I did change also was I started off with as a quant. I would do quantitative work, wait for the market to be healthy, go and do the group work, find the best groups, and then look for the best stocks within those groups.
William O'Neill.
Yes, but what happened? But I misinterpreted O'Neill. Like it was O'Neill, but O'Neill did it a lot better, and I didn't realize that it is sort of in reverse. So I reversed everything. Well, what happened was I was missing all the leading stocks. By the time I saw the market was good and I found the good groups, the best stocks had already doubled and tripled and were long gone. And I was never in the leading. And I go, wow, that thing set up perfect. And I should have bought that. But why didn't I see that? Because I was focused on the market first, and leading stocks lead. So now you did this in a different way, but you reversed. You started off with saying that you were looking at where to buy and sell, then your risk control, and then investment psychology. But it says here that you had to reverse the whole process. That then you said, I'm going to use investment psychology is far more important than risk control, and then where to buy and sell.
Exactly.
So
by risk control, I mean position sizing.
Right. You also went through that where you had to basically reverse the order. It wasn't that you were doing the wrong things. You just reversed the order of them. And that's exactly what I did in a different way, of course.
The easy way to look at it is if you don't have control of your mental processes, you could have the best buy-sell engine telling you to buy and sell. Right. You can have your best. You can take my position sizing book I wrote a few years back. It's got the exact formulas we used at Trendstead in there. You can use those. So now you got good position sizing. But if you're screwed up mentally, you will find a way to destroy those first two. It'll never happen. You'll make mistakes. You'll override it. I don't care if you're totally computerized black box. You'll come in and turn it off someday.
That's right.
you'll mess it up. You
You'll
got to
mess it
have
up.
the mental side. It controls everything.
And that's why I wrote the mindset book, because I realized that was really, when I look back, just like you said, you reversed it and realized that in psychology, your psychology was the most important. I went back and I said, okay, I'm teaching people all these rules. But then I said, what really, really made the difference for me? And what really made the difference for me was my mindset, and
Exactly.
was the thinking. I had the tools and I was taught what to do, early on, and I self-taught myself and I had the experience, and I couldn't make it work until I changed the psychology. And that's why I think this has been so valuable. Tom, I'm sure you and I can go on for hours and hours. This
I'm
could go
sure we
on for a
could.
long time.
I look forward to the next event,
Yeah,
the next episode of Interviewed.
I really appreciate it. It's been awesome. I can see why you are who you are. I see
Yeah,
why Jack Schwager made such glowing remarks
yeah,
about you as a person, and I've heard that from other people too. It's
yeah.
very apparent. Yeah, it's awesome. I'm so happy that I got a chance to do this with you, and I want to thank you very much. I'm honored. I'm honored to have you to do this.
You're very welcome. I'm honored to be honored.
Yeah, and let's stay in touch
Yeah.
and enjoy.